All right, so step two is about the performance obligation. How do we understand how many performance obligations there are? Well, to be considered a separate performance obligation, there's two criteria. We got to know these two criteria. The first criteria to be separate is each good or service is usable on its own or with goods or services it could obtain elsewhere. So let's look at that Myrmidon example, why I added this extra qualifying language. The console is not required to access or play on the multi-user system. All right, well, in this case, if that's the case, maybe I can use a competing gaming system, not Myrmidon, but Achilles or whatever you want to call it. And I can use that console to get on this multi-user system. In that case, the subscription to the multi-user system, that gaming platform, that is a separate performance obligation than the console because I can access the platform with any console or other consoles than Myrmidon's. If Myrmidon's console was the only way to access this multi-user system, there would not be two distinct performance obligations. We would record this as only one performance obligation, and the likely best treatment would be to recognize all revenue, all 3.4 million over 2 years, rather than separate it out, recognize the console as its own performance obligation, a point in time sale that we can recognize the revenue right away. And then only the subscription becomes a period of time transfer. And I say that that would likely be the best because of conservatism. Because when two options are equally feasible, we want to take the option that recognizes less income, that overstates liabilities more. And that path would be to recognize all of this as deferred revenue and only recognize revenue over time as we fulfilled our 2 year subscription. So that's the first one, right? These goods are usable elsewhere and separately, and or separately. The good or service is not highly interrelated with other goods or services in the contract. So, for example, construction contracts, there's a lot of little issues, a lot of little steps, a lot of little pieces that go into construction. You got lumber, hardware, concrete, labor, all permits, all that, right? But the whole purpose of the lumber, the nails, the concrete, the permits is to build a structure, right? That's highly interrelated. And so when we're under a construction contract, we're not worried about, okay, the hardware is a separate performance obligation from the lumber, is separate from the permits, is separate from the concrete. Nah, this is all just going into one thing, a house. This can also be quite the case under what we call software as a subscription. This is a common acronym now in the tech industry, software as a subscription. So when you buy Office 365, you buy that subscription, right? It comes with a lot of performance obligations, encryption, software upgrades, use of the license, right? But all of those pieces are really just the Office suite. They're just aspects of providing applications for us to use in our everyday life, right? So they're so interrelated in this particular product we're buying that they're not separate performance obligations. Some things to know that are just not performance obligations. Any non-refundable processing, registration, activation, setup, startup, whatever you want to call them, basically initial fees are not considered a separate performance obligation. Um, if and as long as we are not providing an additional product or service with this startup fee. So, a lot of times there's an application fee, a registration fee, right? These fees are not providing me a separate good or service. They are just another hurdle, another price point in the way of the buyer to get what they're desiring. Um, if we are providing a separate, distinct service or product, then yeah, it is a performance obligation. So if that fee is actually giving me something of worth, of value, then it can be considered a separate performance obligation. If it's not, if we're not getting anything else, then we just add these fees in when we determine the transaction price. We'll look at that in a second. If there is this sort of registration fee, then, for example, in this uh, example, Myrmidon, we would just add it to the 340, whatever that fee was, because it's not tied to any one performance obligation. It's going to be allocated to both based on their standalone prices. That's the case for startup fees, initial fees, whatever you want to call them. Warranties. There's two types of warranties, and we need to be familiar with them both. There's manufacturer warranties, also sometimes called assurance warranties, are just considered a cost of delivering a quality product or service. So basically, it's an assurance that there are no defects in the product that was sold. Because if there are, then we can bring it right back, right? But this is considered just a cost of of obtaining the sale. They're an enticement, and in that case, it just becomes a cost of making the sale. And this is where the matching principle or expense recognition principle applies. You'll never get away from that in your accounting career. Remember what the expense recognition principle or matching principle says is basically all costs to related to revenues recognized during the period must be recognized as an expense in that same period. We have to match the costs to the revenues they help generate and recognize those particular costs as an expense. So these are not a performance obligation that we have to attend to. It's just an assurance warranty, and we are going to make an estimate based on how much we believe is going to come back, how much we're going to have to cover in terms of warranty. So, an example, suppose that historical averages suggest manufacturer's warranty on the Myrmidon game console equal 4% of the total sales price of $300. Remember, this is just that standalone price of the console. That's the console's standalone price in the package. If I bought it separately from the package, that's how much it cost. If 10,000 consoles were sold, then we'd have to make an adjusting entry to recognize the fact that 4% of the total sales price is going to come back as an expense to my company. Right? We have to recognize that even though it hasn't happened yet because of the matching principle. If we had 10,000 sold, that's 300,000 altogether, 10,000 units times the $300 price of the console itself. And if 4% of that is expected to end up as a warranty return, then that gives me 120,000 that has to be recognized as warranty expense. It's an adjusting entry, just like sales returns that we anticipate and estimate, just like depreciation estimates. Almost every estimate in accounting is an adjusting entry. We debit warranty expense, which would be a reduction to net income. It would be an operating expense on the income statement, a part of making a sale. And until there is any cost associated with it, we would credit a warranty payable. So we would have an outstanding liability recorded that as warranties came back, as we had to pay cash or replace products, then we could debit the warranty payable as we were replacing the product or replacing the sale, and then credit either inventory or or cash if need be. That's an assurance warranty. Extended warranties, on the other hand, are sold in addition, bundled with the product that they are tied. And they're considered in that way a separate sale, deferred revenue, and it's recorded at the time of purchase by the customer. I'm sorry, it's recorded at the time of purchase, that the time that the purchase is made, not that the customer is recording this, and then recognized as revenue over time. So it's distinct from the sale of the product. I can buy the product without the extended warranty. I usually do not buy extended warranties on my products, on my electronic products that I buy. I do buy extended warranty for my laptop, for my phone, right? But certain ones are worth it and some aren't, in my opinion. But we can use these products without the extended warranty. The extended warranty can be bought separately, right? Without buying the product. We can buy a warranty on something that we bought before. So these things are separate, distinct, usable on their own, right? We recognize the deferred revenue on the sale, and that then we turn that deferred revenue into revenue over time. We already saw that a bit. It's a different type of deferred revenue, but here we're charging upfront for a subscription, and then over time, the deferred revenue is becoming sales revenue. That's the same case for an extended warranty. Okay? And a key distinction is whether the warranty provides an additional service beyond ensuring that the product meets specifications. Ensuring the product meets specifications is an example of an assurance, right? I'm looking at the box of what I'm about to buy as the buyer. What was I looking for? Insurance warranty. And it's telling me what I can expect from the product, right? If it's telling me just if my guarantee is just that my product is going to meet what the box says, that's an insurance warranty, a manufacturer's warranty. But if it's additional service beyond that, that additional service beyond is what starts to qualify us as a service warranty or a extended warranty. And yes, they are called all these different types of names in industry, so get used to it, right? Um, Another sort of metric is usually, typically, if the warranty extends beyond a year, then we're talking about a service warranty, right? Because now we're going beyond, oh, I opened it and it didn't work, right? There was a fatal flaw in the construction of my good that did not meet the specifications that were on the box, right? That's not going to happen past a year, I would think. And then so in most cases, when we're past a year, we're not talking about just an assurance warranty anymore. We're talking about an extended warranty. So let's look at a little example with that. Suppose we had that 2-year warranty, 2-year extended warranty that was sold with each console, and it's sold for $15. If 10,000 consoles are sold and 76% of the consoles were accompanied with an extended warranty, how are we going to record that? Well, if we're talking about 10,000 consoles being sold, 10,000 units, and we only want 70%, or only 76% of people actually bought that warranty, then we have 7,600 people buying it that purchased the extended warranty. And then we multiply that by $15. Then that gives me $114,000. That's how much I would get paid by the customers who purchased the extended warranties. So that's going to increase my cash. And because now I have to stand ready to meet the obligation of a return and servicing and repairing the product that I sold, I now have an obligation deferred revenue. At the end of at the end of the year, then we're just going to adjust the deferred revenue account to show that the passage of time has satisfied that warranty obligation. We'll debit deferred revenue, credit sales revenue for that amount, right? That's half of the 114,000. If it's a 2-year warranty, if a year has passed, then we get to reduce our deferred revenue by half of the total sale amount of our extended warranties and recognize revenue with the sale of those extended warranties only at this time. So extended warranties are a period of time recognition that do represent a separate performance obligation. Whereas assurance quality warranties, manufacturer's warranties, just making sure it meets specifications, those are not considered a separate performance obligation. There's no revenue impacts from that. We just have to estimate how many of those warranties we think are going to, how much those warranties are going to cost us, and then recognize an adjusting entry for that amount. So let's look at the Myrmidon example one more time with a prepayment and also some warranty issues going on.